This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is here. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to creators
Mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and fighting.
We're going mainstream.
Kunal, welcome to the Altco's Mainstream podcast.
Thanks for having me here, or actually, welcome to our conference, I should say.
Yes, no, this is live from Morningstar's Investment Conference. It's been a fascinating few days. I want to get to your background and evolution that Morningstar's gone through as a firm, because I think it's so pertinent to so much of this convergence between public and private. But first, a ton of really interesting segments at the conference, content. You interviewed Mark Rowan earlier today from Apollo. You talked yesterday. Would love to just hear some of the things that you've really taken away as you think about where the industry's heading.
So I think there's no doubt that the convergence of public and private is accelerating. And the question is how far it goes and how quickly it moves. And some of that is gated partly by the lack of what we call a common language that makes it accessible to people. Some of that is gated, obviously, by the types of vehicles that are available in different channels. And some of it is gated by just a lack of knowledge, or in some cases, some regulatory hurdles. I think a lot of that is going to change, and it's going to become commonplace, I believe, in the future for an investor to open a fund and see both public and private assets intermingle.
What do you think is the hardest part of making that transition for the industry? Is it that the ability to collect the data is not there? Is it the ability to educate is not yet where it needs to be? Is it something else?
It's a great question. There's probably many factors. And if I look back on when I first joined Morningstar, people will find this hard to believe, but turns out public market investors also didn't like to share the information and talk a common language. And ultimately, it was advisors and individuals who needed it if they were going to invest in the public markets to the extent that they ended up investing in. And I think you see some reluctance today in the private markets too. People are like, oh, it's a secret sauce. I've got something special. And maybe you do, but it doesn't mean disclosure hurts it, right? I remember 30 years ago, people would argue about, I don't want to make my portfolio available. Well, today, no one has a problem making their portfolio available on a daily basis, right? And so you learn a lot of lessons in that context.
So from that perspective, and Mark talked a little bit about this earlier today in terms of the fact that previously private markets, you had an edge by finding a deal that nobody else found. And that's
right.
where you generated alpha. What then in today's world of private markets generates alpha in your mind?
I think there's many different things that can, but if I might oversimplify, I think it's a lot like public markets. It's oftentimes time horizon. I just came out of a session where Ron Barron was talking, and Ron has invested in public and private companies. And I think one of the things that has differentiated Ron is his ability to own investments like Tesla for a very extended period of time. And you see this tussle in the private markets too, because sometimes you have these funds that have these great ideas, but they seem like they're time bound and they trade them away before the full investment potential has been realized. And so you're seeing new structures pop up and whatnot. But I think time horizon is such an important thing in any kind of market and maybe not focused on enough.
So we'll get into that more because I think that's a really important concept, both in public and in private. And as new vehicles are created, what it means for the way in which firms manage those vehicles and the incentives they have. But let's talk about time horizon in a different context. Let's start with your career. You've been at Morningstar virtually your entire career, and that time horizon has been quite long. Morningstar as a firm has evolved. You've had a bunch of different roles at Morningstar, both as an executive, in a product context, and a data context. I would love for you to talk through your time horizon.
Sure. So I started Morningstar as a data analyst. And in those days, my job was to go to the fax machine and pull off the data that fund companies would send us, and I'd enter it into our database. That job doesn't exist today. It's all automated, and I think thankfully so. I have to admit it was not the most riveting job on earth, but you learned a lot because I used that time to learn about the industry, about investing, about funds. I used to study fund managers, and I became an analyst. And then subsequently was an analyst for many years before moving over to the business side, where I've had an opportunity, to touch different parts of our business until ultimately I worked, across the business in a few roles before becoming CEO 9 years ago.
So when you think about Morningstar's evolution, how have you followed as a firm the evolution of the industry?
Yeah. We haven't followed the evolution of the industry. We followed or anticipated the evolution of the investor. And the investors are true north. We're here for the investor. We hear about empowering the investor, and that often means we take positions that piss off the industry. And I think that's okay, because if to a certain degree we're not doing that, that means we're not fighting on behalf of the investor.
What have been the best decisions you've made in the context of pissing off the industry?
Well, I think today, if you look at costs across the aggregate, universe of public markets, Morningstar was one of the biggest forces to drive down costs. If you look at ownership, so you've been focused on private markets. In private markets, generally speaking, those who are investing the money tend to have their own skin in the game. Believe it or not, when I got into the mutual fund business, it was very common for mutual fund managers to not own the funds themselves. And we did these groundbreaking studies where we would look at the returns on the stocks of the asset managers versus the mutual funds that they managed. And in those days, the stocks were always outperforming the mutual funds. So we used to say, buy the asset manager in that case. But we changed the notion of, if you're a public asset manager too, you should own your funds. And we rolled out something called fiduciary grade in those days and really changed the conversation around how boards oversaw funds, how disclosure was kind of done. So all those things have been good and hard fights along the way.
And I think that's a really interesting leitmotif to then take that to the private markets where the industry's changing.
Yeah.
Public is looking a little more like private, and private is looking a little more like public in the context of particularly these evergreen funds. You recently put out a report on evergreens or semi-liquid funds.
Yep.
And you also launched medalist ratings of evergreen funds, which I think is a huge development for the industry because it's important to create that level of transparency. But how do you think about some of the things that happen in the mutual fund world and how that's evolving in terms of private markets and some of those parallels between the two industries and how you're trying to play a role in now the development of private markets and making that more transparent?
Yeah. It's a lot to cover there, but if I had to simplify, when you look at private markets and some of the hurdles that maybe prevent common investors from maybe accessing them, among the things that are hard is there's illiquidity. There are, I think, hard to understand cost structures. They don't always make sense. And there's some complexity in the terminology around exactly what some of these funds are doing, especially on the credit side. I think on the equity side, it's definitely a little bit easier, but on the credit side, it's a little bit more complicated. And so when I think about what needs to happen, and you're starting to see these things get tackled, first on illiquidity, used to be the case too that in the public markets, you didn't have as much liquidity in vehicles as you do now, even with ETFs. Well, what do you have happening in the private markets? Well, you certainly have the development of interval funds, but then you have a firm like State Street partnering with Apollo, and they've got an ETF out there already in the private credit space. I think that is just the first of many vehicles that are going to start experimenting and testing the limits of whether the liquidity equation in private markets can be changed. And it's interesting because you heard Mark say today, he doesn't think that that's where the excess return actually is gained. It's more on the origination side. So which would mean that potentially in a vehicle like that, you don't actually give up anything for having that level of liquidity.
What, in your mind, then, is the intent of these evergreen vehicles? Because I think liquidity, illiquidity is a question that investors have. But as Mark said as well, that's just one vector of risk. And maybe that's a perceived risk relative to an actual risk.
Yeah.
Public markets may also have illiquidity in terms of how, particularly in fixed income, how fast something can be traded. And if you have a longer time horizon, like you were talking about earlier, maybe liquidity doesn't matter as much as people think it does. So what do you think the intent is of these vehicles that are being created for private markets? And are they really there to deliver what private markets intends to do for the investor?
Well, I think the skeptic would, I think, rightly say that partly they exist because there's some FOMO there, right? I think a lot of private market investors essentially traded away companies that then continue to compound, and they look at them and they're like, well, we should have held on to them, which isn't a bad thing, by the way. I kind of believe in time horizon and holding on to things that, make sense to hold on. Obviously, it means you have to have some skill in evaluating the entire life cycle of a company, which is a totally different skill than, say, thinking about what might happen over 5 years or 7 years as a holding period. So there's a little bit of that going on. But I also just think fundamentally, if you look at where the most suitable pool of assets is to kind of invest in these types of vehicles, it's essentially in things like the 401k. And, if you're a 30-year-old investor, it makes perfect sense, let's say in a target date fund, to have some exposure to these types of vehicles because you do not need that money for 10, 20, 30 years. Forget the 10 and 20, actually. You don't need it for 30 years, conceivably. And so why would you not want to try to take advantage of the compounding effect of doing that? I mean, you see that even in the public markets. One of the biggest costs that is imposed on investors is trading costs or tax costs. You don't obviously have that in a 401k situation, but it sort of really points to, I think, the ability to compound your money smartly and thoughtfully.
So then how do investors better understand the different structures and the different types of vehicles that are out there that they can invest in?
There's a lot of work to be done on that front. It's not easy today. It's part of what I think Morningstar is really now focused on. And you heard me talk about yesterday that there needs to be a common language that exists because it's not just a structure. And there are several structures, interval funds, semi-liquid. You have the occasional ETF that's launching now in the space. And I think you're also just going to have regular mutual funds that will own stakes in public and private companies. But I think the complexity is less at the structure level today and more at the fee level. There's too much variance in the way fees are charged. And part of what we just showed in the study is that the typical fee in some of these semi-liquid vehicles that have been launched is 3 times what it is for a typical mutual fund. That is a very steep hurdle to overcome. So as much as I am bullish about why and how investors could essentially, in Vanguard's words, own the haystack, because the haystack has private companies today and private credit in it, I'm also cautious about the fact that it costs a lot, and those costs have to come down and be explainable, right? And so, to me, that is the bigger hurdle that will need to be normalized.
What do you think is the most important information, education, and data that you can deliver to investors to help them understand that?
I think if we can deliver a simple total cost, that is probably the easiest thing to do. And again, believe it or not, in the public markets, it used to be that you couldn't always compare a total cost ratio. You had front-end load funds, you had back-end load funds, you had no-load funds. It's sort of similar in private markets right now. There are different structures. And I think getting to a spot where total expense ratio, TER, looks entirely the same for comparability is going to be important. I think that's one thing we'll want to spend some time on.
How do you think about not just the comparison between private markets vehicles, and I want to get to that in a little bit, but while we're on the topic of public and private and kind of porting over some of the mindsets of how investors think about vehicles and structures and fees in public markets, how do you think investors will compare public versus private, even as there's convergence? Because to your point, sometimes fee hurdles might be too high in private markets products. Maybe investors would be better off just investing in public market products.
I mean, ultimately, the results have to be comparable. And so you asked a question earlier about what's the most important thing you should look at. And I started with expenses because I think expenses are the great equalizer. But ultimately, the language of returns needs to be comparable too. I think it's great if an investor commits to investing in something that's less liquid because they have a long-term horizon. But that doesn't mean they should give something up, nor does it mean that it shouldn't be comparable to an equally good investment in the public markets. If you can invest in an index fund or a great actively managed public mutual fund, it should be comparable. And so we want to get to that spot. And actually, with our semi-liquid rating methodology, the idea is to set it up so we're not just comparing private against private over time. We're comparing private versus public, which is, I think, the way you should be building a portfolio.
I think you're getting to something at the crux of where private markets needs to go as an industry, which is one, how do you take a total portfolio approach? Look at both public and private as part of a portfolio, what the risks, liquidity, et cetera, looks like. And then think about that in the context of model portfolios, right? Different firms are doing it in different ways. Some are doing totally private model portfolios. Some are doing public and private model portfolios. How do you think about that evolution as part of the industry? And what data needs to be available and digestible in a way that starts to get to that ability to analyze, like you say?
So I think one of the things that the SEC has done well in the public markets is that they have essentially allowed for standardized documentation. It's all over the public markets. I think at some point, if in fact private markets continue to go mainstream, it is the right thing for there to be appropriate public documentation that is comparable and useful across the universe, and also in a way that doesn't differentiate a whole lot from public markets. And I think the SEC will ultimately look at this. And I know people get nervous sometimes when they say, oh, well, it's a regulator or whatever. But part of the regulator's job is to ensure investor success as well. And there's going to be a lot of innovation in this space. And I think the SEC can actually help with the innovation by ensuring that there is a level playing field and also that information is, shared in a certain way. And so that obviously helps someone like Morningstar, where we can then gather that information and present it. But I think it goes to the heart of how the industry grows and has an impact with investors too.
On that point too, I think you're getting to something which is so critical, which is delivering information and education to investors. A number of firms in the industry do education well, right? Blackstone has Blackstone University, Apollo has Apollo Academy, and so on and so forth. You're an independent firm, though. How do you think about educating the investor, and what gaps do you think are still prevalent in the industry in terms of being able to educate the investors well, both advisors and clients or end consumers?
Yeah. So my answer might have been a little bit different a couple of years ago because I think the gap was wider. I think the gap is a little narrower today because so many Americans work for PE-backed companies, right? And so I think part of the interest is actually stemming from the fact that our friends and neighbors aren't just working for public companies anymore. They're working for PE-backed companies. And so they have experience at that level. But the average investor, I think, has less experience with vehicle types, fee structures, and things like that. So to my earlier point, the language has to start with just some basic understanding on structures that are available, the way returns are calculated, and the way fees are assessed. Then I think you kind of go from there and create a language around comparability. And that's where things like, Morningstar created a style box for the public markets. What does a style box look like in the private markets? We have valuations for companies in public markets all day and night long. How can we find something comparable so investors have some type of idea of what's going on there? And you're seeing some development of markets that are going to do it, but we have all the data to start allowing for that. And I think it's inevitable that you're going to see more developments on that front.
Is the data available fast enough in terms of as these vehicles mark themselves, and in many cases with evergreens or interval funds, many are monthly NAVs, some are daily NAVs. Is the data available from these vehicles fast enough for you to then create the right type of analysis that you need to deliver to investors?
It's not today. But what I would say is that those firms that see the future and think about how to serve the wealth channel and how to help advisors, for example, understand that to do it effectively, they need to change the way they themselves gather and share that data. And they are forces for bringing the industry along as well. So some of the firms you named see the opportunity, and they recognize that without that common language, there's always going to be a hurdle to adoption. So
do you think you don't have a dog in the hunt in the sense of specific product types and structures? Do you think that there's a decidedly best type of structure in a tender offer evergreen structure or an interval fund? Like, it's seeing the entire market, being able to evaluate it all. Is there one structure that's best for investors?
yeah. So among the things that exist today, I think the interval fund structure is the most effective, and it's also governed, I think, by the right set of rules. So I like it for those reasons. What it lacks is the kind of liquidity that I think we all desire, and I think full transparency and fees is not as is not where it needs to be with that structure. And so when I see a State Street partner with an Apollo, or I see a Capital Group partner with a KKR, or I see a Vanguard partnering with a Blackstone, I think I'm really interested in those types of structures as well, because they are going to move beyond the interval fund to more traditional structures with more liquidity and with firms that are going to drive down costs.
So when you talk about these public-private partnerships, and not to discuss any of these in particular, but I think there's a really interesting philosophical question around this, which is, as private markets becomes more public, I think we can both agree that more public in the context of transparency, access to information is all good, and access to vehicle type and structure is all good. But do you think there's any element of square pegging, round holing in the context of certain vehicles in private markets being created, and it's not necessarily achieving what the intention of private markets is supposed to achieve? Because private can mean two things in private markets. It can mean, in one sense, it's only been available to certain people, but private in another context is there's a reason why companies are private, and there's some inefficiencies in private markets that firms have been able to benefit from as they invest, which create excess return.
Yeah.
Do you think that there's any sort of, it's more of a philosophical question, but like, as the industry tries to open up to more investors, having funds that are marked on monthly basis or daily basis, investors often manage to the expectations they have. Does that then change returns? Does that then change what the actual intent of private markets are supposed to do and what they're supposed to do in a portfolio?
It very well could. And at least that is what I think the assumption is that of many people who are skeptical about this move. What I'll say is that it will test the hypothesis, though, of whether illiquidity has really served as much of a purpose as has also been claimed, right? And so, to me, the best thing about illiquidity is actually that it keeps investors invested, right? It's not that someone's got a magic formula and by, investing it in a certain way, they're able to have more success. It's because they're letting compounding work for them. And our research in the public markets, too, has shown that some of the most successful funds for investors are the ones where money tends to stay, like target date funds. There's a reason why the investor returns in target date funds match the published returns, because investors stick with them, as opposed to that hot dot fund where the published returns are super high, but the investor returns are all over the place. And so that's what I would say in response to your question.
Where my mind goes with that is in the context of evergreen funds. Yes, there's a case where an individual investor has a life event, they have a divorce, they have someone passing in the family, they need liquidity in a certain context, they want to buy a house. All of that all makes sense. But is the way that investors should think about evergreen structures, particularly in probably talking more private equity, although private credit actually could make sense to have that compound as well. Should people think of those as buy and hold vehicles with their illiquid vehicles with the potential option of some modicum of liquidity rather than semi-liquid vehicle?
I think it's well said. I would agree with that. I think one of the things like an advisor is always trying to do is look at a portfolio and say, how do I build an allocation? And candidly, today we say that if you're 20 or 30 years old, you should be 100% equity, right? If that's the case, we're basically telling you you shouldn't be touching your money or doing anything with it for a very, very long time. And so it seems perfectly reasonable to me that you have something like an evergreen structure in a portfolio like that, which is not going to need to be traded and can just compound for years and years. As someone is approaching retirement, it's no different. In the public markets, you'd be reducing risk. And if to the extent you have starting to invest in private markets or you have invested in private markets, I think if you need that money, you need to start reducing your exposure to that way. So it's good old fashioned asset allocation. There's no like rocket science here. I think sometimes people perhaps want to see if there is, but there's not. It's less liquid vehicles mean longer holding periods, and you should treat them as such. And you're right. Perhaps the structure of having even less ability to trade is not a bad thing in that context.
I think that brings us to really interesting topic around the behavior and how investors approach things. You work with both individual investors and advisors. I would love for you to discuss what those two investor constituents want, how they want them when it comes to investing, thinking through portfolio construction, asset allocation, and just accessing information and data. Because I think you operate at the intersection of data and content.
Yeah.
Both of those things are important for both constituents, but how similar are those constituents, individual investors, advisors, in terms of what they want, how they want it?
They're relatively similar, but the use cases and how they deploy the data can be somewhat different. And what I'll say is like individual investors get dumped on all the time, right? There's this sort of belief that Wall Street is smarter than Main Street. And I would just say that in my experience, that's just not the case. Main Street investors, who advisors mostly represent, are actually pretty smart. Are they emotional? Yeah. But turns out so are institutional investors. And every day you see market volatility, it's actually not really coming from retail investors because they don't control the vast majority of assets. And so retail assets actually tend to be pretty stable and sticky once you have them, even compared to institutional assets. It's why if you kind of go to some shops that in the 90s used to have direct-to-investor businesses and ask them, are those assets still around? You'll be shocked as to how long those assets have been around.
Do you think that younger investors, one, they've grown up social, two, they've grown up with retail brokerage apps that they can trade at any point in time during the markets? Well, if we talk about crypto, then they can trade 24/7 every day of the week. But that mentality and mindset and accessibility, I think we can actually talk a lot about how maybe that's not good for investor behavior long-term in terms of what they're learning. But how does the way in which younger investors have grown up social, both in social media and investing, how do you think that impacts all the things that we just discussed?
Well, one of the things I'll say is they are exposed to the phenomenon of private markets way earlier than their parents ever were. And even on the VC side, many of them aspire often to kind of start their careers in higher risk kind of companies because they have that ability and desire to do something to change the world and benefit from it personally. And so I think they come with a certain level of comfort to these kinds of conversations. All of that said, I mean, it's been an amazing 20-year run for the markets, basically any kind of market. And so the thing they have not seen is a meaningful drawdown in their assets for an extended period of time. And I think there always ends up being one when everyone predicts there's not going to be one. And so the question is, how will they do in that type of period? And I don't know is the answer.
Do you think that, sorry to interrupt, but where my mind goes with that is, do you think once that happens, people will actually shift to more advisor-led models where they will actually want to have a financial advisor, or do you think they'll want to stay self-directed?
So my experience is that people tend to want to have an advisor once they've built up their wealth to a certain amount. And it's not just to manage their money, it's because an advisor does multiple things for them, right? Including helping them sort of plan for how to kind of preserve their money into retirement, do charitable things, all those kinds of things. So I think the reality is like, even at Morningstar, when we think of investors, we always sort of think of the 20-year-olds as being interested but distracted by their lives. And so very few of them are at that stage in their life really thinking about it. The 30-year-olds tend to be starting families, be in the thick of it with their jobs. And so they aren't as serious. The 40-year-olds are kind of starting to think about investing, but they're also in the part of their careers where it's very, very intense. And they're also like in the part where the kids are the most expensive, right? Sending them to college and whatnot. When you get to 50, your career is probably either at its peak or you're starting to slow down. And guess what? The kids have left. And so suddenly you look and you're like, okay, I'm 10, 15 years away from retiring. Have I got my act together? And that's often in that 40 to 50 year range when the advisor will get the call. And it's interesting too, because many people opt to become advisors in their 40s and 50s. It's not the first career choice that many advisors make, but they get there over time themselves. And so I think there's something to be said for that.
What do you think is going to be the biggest difference between younger investors who've grown up social and investors from past generations as this generation of investors grows up?
Yeah, one of the reasons Morningstar succeeded in the early years is because individual investors used us for validation. And I think that when I look at younger investors today, they want everything validated and they have more information than ever before. And so I think to the extent that they ever get professional services, and they will, they're going to want validation and seek their own sources of truth more so than their parents ever did.
So where does that put Morningstar? Because I think where my mind goes with that is, one, there's so many places they can get information, and information is disseminated quickly through social media channels. You also have AI.
Yeah.
How does all of that impact how Morningstar thinks about serving individual investors and giving them the transparency that they need?
Yeah, I started at Morningstar partly because I love the Morningstar voice. Even as a kid in college, I had an interest in investing, and the Morningstar voice resonated with me. We just said what was on our minds without any regard for what it meant for our business. And to this day, our analysts will say what is on their minds without any regard for whether I'm getting calls on the other side from people who are pissed and threatening to pull business from us because our analysts are saying what they have to say. Nobody else does that. And I think with every generation, that independent voice just resonates. And we're going to keep it that way.
Do you think that in today's world where having that type of voice is probably even more powerful, that actually resonates even more with investors?
I don't know if it's more or less powerful. There's always stuff going on, and, transparency and independence always have a role, but very few people embrace it as part of their business model and their mission, and we just do. It's really hard to preserve.
On that point, when did you think about creating more transparency in private markets? You have done things like buy PitchBook. We talked a little bit about some of the products that you rolled out, like the Medalist funds for Evergreens, which creates a lot of transparency for the space. When did you look at the business and also look at private markets, which were not transparent for quite a long time, and say, this is a market that we want to unlock for investors?
Well, it started in the early days of PitchBook. Morningstar, well before we owned PitchBook, was an investor in PitchBook. And so we anticipated and saw the potential. Now, I think even when we bought PitchBook, we didn't anticipate the degree of growth and how quickly it happened. So those are happy occurrences in that context. But I think the opportunity has been there because even if you're an institutional investor, you go to an asset owner, a sovereign fund, an endowment, and kind of ask them what the reporting looks like and what the experience looks like to own a PE-backed vehicle. It's not great, even to this day. And so we've kind of identified that as something where the data's been lacking and hard to get. And that's sort of our bat signal, right, so to speak.
And I imagine in the earlier days of PitchBook and other firms in the space, the Cambridge Associates, the Prequins, et cetera, the Burgess is now part of MSCI. It hasn't always been easy to get data, particularly from GPs, right? Do you think we've reached a tipping point in that regard in terms of the industry now, because it has become more mainstream and has to work with the individual investors or the wealth channel, that there's a tipping point in transparency that firms know that they need to work with data providers to share that data and make things more transparent?
I think there's no doubt that that will continue to happen and accelerate. But I think even without that, that realization was coming about. Because guess what? If you were a VC looking to fund a company, you're going to look at PitchBook for the comparables. If you are starting a company and trying to raise money, you're going to look at PitchBook for the comparables. And so it creates this flywheel. And I think PitchBook hit that several years ago, where it became about wanting to be in PitchBook because that became essential to the workflow of a VC or a PE firm. And so what you're talking about now is sort of the extension of those use cases into other parts of the Morningstar universe, and I think that's inevitable. Even benchmarks, right? We've launched like the Morningstar PitchBook unicorn indexes because there's demand now to try to understand how should I actually evaluate what's going on in my private portfolio.
You mentioned the word index. We can't talk about what's going on in private markets without talking about index, at least from a conceptual perspective. How do you think private markets indices, if at all, will unfold?
I think the road is a little bit different than it was for public markets, partly because the tradability of some of the securities on the equity side in particular is somewhat limited. But I think on the fixed income side, it's fair to say that when you look at public market fixed income indices, there is a way to kind of get private credit indices along the path to where you'd I think, have very good proxies and the ability to invest in them. I can see those markets developing a lot faster. I think for private equity, it's going to be a longer road. But in terms of just, and I'm talking about really making them investable. In terms of finding the right ability to benchmark against them, that work is underway. And I think we'll continue to make good progress as a firm in the near term.
What is going to be the most challenging part of being able to create the right data pipes and being able to benchmark against private markets funds?
I think it's probably the fact that there are so many different styles and approaches. And in the public markets, we've got categories. And the categories serve as a really good map through which you evaluate things. And we want to do the same in the private market. So today, if you go in PitchBook, there are ways already where we segment different types of investment options. And I think we're just going to need to make that more granular and on point so there's comparability in a more meaningful way, as opposed to just here's the whole universe and how does it stack up to each other.
That's kind of how public markets has unfolded. It's heading that way in private markets. What do you think, as you looked at some of the evolution of the market and market structure in public markets, in mutual funds, ETFs, there's been certain aspects of that industry and that market structure that has evolved in ways where there's been decided and clear winners in a sense, right? I think there's a lot to learn from what BlackRock did with iShares. But not just in terms of product, but education.
Yeah.
Scale really matters. You're seeing some of these same trends, the ability to educate, market, maybe there's fee compression. How do you think about what's happened in public markets and mutual funds, ETFs, as you think about where the evolution of private markets might end up?
Yeah. So if we look at the recent history of public markets, it feels like so much has happened in such a short period of time. And the reality is, if you're an observer of public markets and you go back and look at it, all this has unfolded over decades. And it's true that there have been places along those decades where the acceleration has been faster than other periods, and recently it feels that way. And I don't think it's going to be any different than the public markets and then private markets. It's going to take time for this to play out. It's going to take time even for private markets to become a significant part of people's portfolios, right? Like even getting to 5% of people's portfolios, it's going to take time. I know like Mark this morning was talking about the fact that he thinks he can get there even faster. We'll see. But I think the recency bias in the public markets sometimes takes away from the fact that the reality is it's taken a long, long time. Even for indexing, gosh, when I started, I remember Jack Bogle used to try to convince people about indexing, and people still thought he was kind of a marginal player. This was within the last 30 years. Hard to believe. And so I think we will look back on private markets as they evolve and become more accessible and liquid, and there will be periods where we will be like, wow, this is moving really slowly. And then we will be in periods where it's going to move so quickly. And I think we're in one of those periods where by the time you turn around and look at it, you'll be like, wow, that moved more than I thought it would.
What do you think is going to be the next wall where private markets market structure evolution is going to hit, and it's going to start moving a little more slowly than it maybe has been?
I think the big wall is fees. And, this was the case in public markets as well. It took a while for competition to materialize and for the index funds and other low-cost managers like Dodge and Cox's to really, I think, hit their stride. But once you do, that snowball is not stopping.
So does anybody start to play the race to the bottom game sooner rather than later and try to get ahead of that?
I think you're starting to see that already. The players who are getting into the space, the vanguards, the capital groups, I mean, they're bringing trillions of assets into the space. And I don't think their edge is going to be gained from having high fees. They gain their edge from driving costs down.
That's certainly the case, and that's their ethos, and an important service to investors.
Yeah.
The question that comes to my mind, though, is the operational burden and overhead. Can you have fees like you do in public markets in private
Why does
markets?
the operational burden and overhead need to exist? Like, why?
What do you think changes that? Is there a technology? Is it tokenization? Is it?
It could be that.
AI
It could be.
and
It could just be the
fund
type
admin,
of vehicle. The types of vehicles that today most people access the markets through are reserved for certain types of investors, and that brings along a whole lot of paperwork and a certain type of investing ethos. And I think at scale, you can't just have that kind of stuff. And certainly, just changing the vehicle structure changes that. And so we can kind of get to the point where we talk about tokenization and stuff like that. But even before that, just the structure and simplifying that changes everything.
So you think about the evolution of market structure from pre to post trade in public markets and the life cycle of a trade. You think about that same life cycle of a trade or investment in private markets. If you could wave your magic wand and say, you know what, this is a piece within the life cycle of a trade or investment in private markets, market structure that I could change or make better right now, which part of the life cycle would it be? Would it be pre-trade? Would it be execution? Would it be post-trade?
I think it's probably pre-trade. It's very complicated. And I think there's just a mountainous, burdensome amount of paperwork and complexity.
What do you think would be the biggest unlock in changing pre-trade market structure in private markets?
I think it would be going to structures that do not limit the minimum level of investment to the degree that they do today. I mean, the fact that you have to be a qualified investor to access a lot of those vehicles adds a lot of the burden to what happens in the early stages of, whether you get to invest in that fund or not.
Brings up another really interesting philosophical point, because if you think about the way some of these publicly traded firms are evolving, so some of them, and it's hard not to walk by the conference here and see Global Atlantic, right? KKR. So my head goes to KKR. They own Global Atlantic. That's one of the three pillars of their business. But the third pillar of their business is strategic holdings, which is, they've called it a mini Berkshire Hathaway. Is the easiest way to give investors access to private markets through investing in the stocks of some of these publicly traded alternative asset managers, where KKR's thinking about growing their balance sheet and their long-term strategic holdings unit, and they're not the only one, and every firm does it in different ways. So that's just one that I mentioned to kind of illustrate this concept that we're talking about. But does that become the easiest way to enable any investor to have exposure, as we're talking about, like, how do you make it structurally easier for investors to access private markets?
Well, it sort of goes back to the study I was telling you about earlier, where the public, back in the 90s and early 00s, the public market asset managers had their stocks always do better than the underlying funds. I think the problem with that thesis is that you end up in a very concentrated position with a portfolio that's going to behave very similarly over time, vis-a-vis the diversification benefit that I think you want to pick up by going cross-industry.
Brings up another really interesting question, which is, and Mark alluded to this a little bit earlier today, he said it before, which is returns may go down in private markets. There's more capital coming into the space. It's harder to generate returns. You really need to work on value creation if you're a private equity firm and do that well, and that will probably separate the wheat from the chaff. There's also a world where private markets should still if they have a reason to exist, per excess unit of risk, you should have excess unit of return, as Mark would say.
Agreed.
Do you think that private markets is now as much about diversification as it is about returns?
I don't think it can be. And part of that is my own hunch here. So I'm not going to say that there's any like research beyond this other than kind of my own hunch. I think because of the fact that we've gone through at least 2 decades, if not longer, of really good returns on the public and private markets, correlations are much likely to be greater in the future than they have been in recent decades. And I think the diversification benefits are possibly lower than what people expect. And, you know, I think of even just this April, you had the public markets behaving in a very negative manner. And what was the outcome in private markets? The outcome was people couldn't find liquidity. IPOs got stalled and whatnot. To me, that hints at a lack of diversification. Similarly, on the credit side, what was going on? Well, surprisingly, the credit markets were largely okay on the public side and on the private side. Issuance continued. And so that tells me that like the diversification argument is less valid than probably it used to be.
So that gets...
And we'll see.
Yeah,
Again, this
yeah.
is like, there's no research behind this other than my own hunches.
I want to hear your views, because the next question I'm going to ask is about what do you think is the thing that people aren't thinking about enough in private markets today?
I think it's not any different than what they're not thinking about in public markets, which is that in a world where returns are potentially lower, how do you build a great portfolio? And how do you ensure that those portfolios' returns match the expectations you have for what goal you're trying to get to? So whether you're a sophisticated pension fund that's trying to match some outcome, or whether you're an advisor trying to get a client to a certain outcome, I think people have not gotten their heads around to what a lower return environment could look like.
What do you think is going to be most important in terms of investing well in a lower return environment?
Lower cost.
What do investors need to be able to understand in order to navigate a lower cost investment world and a lower return investment world?
Well, first you need the information. And this goes back to what I said earlier, which is you need comparability of the TER, the total expense ratio, which we do not have. But I think beyond that, it comes down to good old-fashioned manager selection or owning the haystack, as in focus on getting full exposure through an index and owning that. Obviously, you can't do that in the private markets yet. And all I'll just say is if that's your preferred approach, it's okay not to have any. I think the public markets overall are a perfectly good place to be for a lot of investors. I think private markets are interesting and useful if you're willing to think about time horizon a little bit differently, liquidity a little bit differently, and so on.
So you bring up manager selection. I think that's a really important piece to unpack, because that gets to a number of things when it comes to particularly the wealth channel, both advisors and individual investors. There was a Bain company study in 2022. It's a little bit outdated, but it probably still holds true, which is they surveyed, I think, 450 or so high net worth, ultra high net worth investors, asking them what comes to mind when, what firms come to mind, top 3 firms, when you say alternative assets. The first and largest answer in the bubble chart was, I don't know. The next few were actually traditional asset managers. So like Fidelity, Schwab, BlackRock. At the time, certainly BlackRock is if you look at them relative to the alternative asset managers, they're actually probably top 10, given the HPS and GIP acquisitions, in addition to their own private equity program. But none of the largest alternative asset managers were in that, and that says something about brand. Right? How do you think investors should navigate the world of brand and performance, and how do those two things intersect?
Well, first of all, brand isn't everything, and you have to look under the hood. And not to speak my own book here, but I think that's where Morningstar comes in, and we have to help investors navigate that complexity. And so when I talk about a common language, I talk about the importance of finding ways to explain to investors what the trade-offs are for investing in certain types of vehicles. It's where we got to help, and it's part of our efforts is developing not only the data that allows that to happen, but the IP on top of it. Like one of the wonderful things about the public markets it allows for easy comparability today. And we have things like the star ratings, we have things like fair values, we have things like style boxes. We need to create similar IP for the private markets. And so that's going to be my focus and our focus as a firm.
So you talk about your focus. What is your most strongly held belief about private markets?
I believe there's a lot of opportunity, and that while historically private markets were maybe viewed skeptically by some corners of the universe, they are changing enough that they're becoming part of the entire investment haystack, right? So the appeal of indexing the public markets was always that you got the full economy. And I would say you largely still do. But it's also not lost on anybody that the number of public companies continues to shrink while the number of private companies continues to grow. So in Bogle's words, if you're going to own the haystack, probably the most compelling thing is the haystack looks different than it previously did. And so how do you end up owning it?
It's a great segue to the final question that I ask. And honestly, I think this is a perfect question to ask, given the ethos of Morningstar, which is about transparency, then delivering that to the individual investor. But I always like to ask investors and people who come on the show, what is your favorite or most interesting alternative investment? And we'll ask that in the context, the world has changed a lot and it's no longer what it was. So going forward, what is your most favorite or interesting alternative investment?
I don't know the answer to that just yet. I'm not sure it's been created, but I'm very interested at some of the structures and vehicles that are being created in the private credit space. Because when I do look at private debt in general, or the debt markets in general, so much of what is being issued and owned today is in the private markets. And so when I think about the context of my own portfolio and how I would maybe like to change it over time, that's part of what I think I find quite appealing. And then second thing I'll say is I am intrigued by evergreen funds just because I do believe in compounding and letting time horizon work. And so I think those types of structures exist already in the public markets, but it's interesting to see others who are private market investors starting to stretch into them.
Oh, and the good news is that we'll be able to have more and more data and transparency on them thanks to all the work that Morningstar is doing. So Kunal, thank you so much for having me.
This was fun.
Great conversation.
Yeah, it'll be really fun to revisit this and see what actually comes true in 5 years.
Absolutely will. Thanks so much for coming on the show.
Thanks for having me.
Pleasure.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going